So when you have a commodity business where people have specialized capital and they make those investments, what happens over time everywhere, in every industry, in every commodity in the history of the world, is the producers overproduce the commodity because, in the phrase of Hotel California, you can check in anytime you want, but you can it's a one-way route.
Right.
You go in, you can't get out.
This is the second part of one of Michael Saylor's interviews on the superiority of Bitcoin. To get the best of the discussion, ensure you watch our first video on the interview. In the first part of the discussion, Saylor, the CEO and co-founder of MicroStrategy, picks apart various means of channeling monetary energy. Whether you want to put your money in gold, copper, or electrical energy, the billionaire Bitcoin bull explains that these energy forms are all fatally flawed. In his interview, Saylor further discusses the problem of channeling and storing monetary energy using gold. He explains that if someone stored their gold in a bank vault in many of the major cities in the world 122 years ago, there is a high probability that they lost it all before the year 2000. This alone proves that the commodity is inefficient as a way to channel or store monetary energy. Before we get to the entrepreneurs part of the video, please click the like button and subscribe to the channel. You could also drop your comments and observations in the comments section below. We appreciate all our viewers and subscribers for their immense contribution to our growth. Please enjoy the video.
What if you put $100 million worth of gold into a bank in Frankfurt in 1900? What if you put it in the largest bank in Japan, in Tokyo, in 1900? Name a city you could have, and a bank you could have put it in 1900 that would still be there in the year 2000. It's a short list, by the way.
Yeah.
London, Switzerland, Zurich, New York. You would have failed in Paris, Berlin, anywhere in Eastern Europe. You would have failed in Moscow. You would have lost it all in Beijing. You would have lost it in Tokyo. You would have lost it all anywhere south of the Rio Grande.
Yeah. And in the
You would have
U.S.?
lost it everywhere in Africa.
Possibly would Executive Order 6102 have impacted you in the U.S.?
And you would have lost it in the U.S.
Yeah.
Okay. Isn't it ironic? Okay. So can't we reduce it down to maybe Switzerland? Maybe.
Yeah.
Like, it's an interesting exercise for the reader, but the counterparty risk on gold is at the municipal level, the state level, the federal level, and the corporate level. And that's, and over a lot, there's a phrase, right? Over a long enough timeline, the mortality rate is 100%.
In the long run, we're all dead, right? Sort of, I think Keynes may have said that.
He said it. Robert Heinlein wrote a book called Lifeline, and he said, over a long enough timeline, the mortality rate is 100%. In this particular case, back to our gold network. We have a gold network, and we want to move money. So I put $100 million in gold, and I want to move it around. Well, it's 25 basis points every time I move it around the world. If I move it once a quarter, it's 1% bleed a year. If I move it once a quarter, okay? If I mine it, it's 2% bleed a year. That gets me to 3% bleed a year. Divide that into 70 and every 22 years, that's the half-life of gold. Energy on a gold network has a half-life of 22 years at best. When you throw in the counterparty risk and the need to move it around, let's just assume we're moving it around so we don't lose it. You're just down to now the issue of technology and commodity risk.
Apart from the counterparty risk associated with gold, Saylor states that it is also affected by a critical issue that affects all other commodity types. That is the human reflex to overproduce, even if it drives prices down.
This is an important point. Gold is the king of commodities. Gold is the greatest of all human commodities. But my first job at DuPont was I built computer simulations of commodities and specialty chemical networks. And let me tell you what people in that business think. They think commodity is a dirty word. The first thing I learned is commodity is awful. Nobody wants to be in a commodity business. And here's the reason commodities are awful. If I actually create a factory that creates a commodity, say gasoline, The only thing it can do is create gasoline. If I invest $10 billion into a gasoline refinery, my fixed costs are $10 billion. The ideal rational price for me to make a profit, call it $4 a gallon, but my variable cost is $1.50 a gallon because I've got all these billions of dollars in the factory. What happens is when I create commodity refineries, when the price goes below the profitable point, I can't do it. I will still keep running the factory because I've got a variable margin. I'm generating cash flow, even though I'm driving the price down for everybody else in the business. So it's possible in a commodity business for every single producer to be losing money and from them to all be acting irrationally, and they're all pumping out the commodity, be it silver. If you're a gold miner, what can you do other than mine gold?
Right.
Once I've gone and I've invested $100 billion in mining gold, if the price of gold is cut in half, but my variable cost is $400 an ounce and it's $800 an ounce, I'm mining gold and selling it at $800 an ounce. I'm selling it at $700 an ounce. I'm selling it at $600. When it gets to $500, I'm selling it because the market is not rational. I can't transmute my $100 billion of gold mining capital into Google stock.
Right. The switching costs are too high. It's just not possible.
And by the way, maybe I've been captured by the government. Like maybe a certain government wants to mine gold. Maybe I can't legally stop, even if I wanted to stop. So when you have a commodity business where people have specialized capital and they make those investments, what happens over time everywhere, in every industry, in every commodity, in the history of the world, is the producers overproduce the commodity because, in the phrase of Hotel California, you can check in anytime you want, but you can it's a one-way route.
Right.
You go in, you can't get out. So so that takes us to this real issue of gold, or the real risk of gold, which is gold price goes up by a factor of 10. Capital gets attracted into commodity production. It's a feedback. People produce more. Gold price comes down. People keep producing to try to recover their cash flows. Lots of intelligent people become desperate. When men are desperate, they invent new techniques to produce more gold. They keep producing because they don't have a choice. They will produce down until the variable cost equals the price. Then they will keep producing below variable cost.
On the one hand, we have Bitcoin, the first and most successful of its kind, built on a technology that has been lauded as one of the greatest of our time. With its fixed supply, there is no need to worry that it will be overproduced. Plus, you don't have to move it around the world several times in a year to keep it safe. Then you have gold, a great commodity nonetheless, but one with many fatal flaws. Which are you placing your money on? Please drop your answers in the comment section below, but note Bitcoin is the only correct answer. Thanks for watching the video. If you haven't, please check out the first part of Saylor's interview and remember to give this video a thumbs up.